Support material 15. Okay, so recap. We've got the accounting process. When looking at 1502, they're going to focus on the last step. This one, the financial statements. What are financial statements?
Statements of the company.
That provide information on what?
The income.
Well, the transactions.
Yes.
Okay, so do you agree transactions are going to filter through the journals, filter through the ledger, and ultimately end up in the statement of financial position?
Yes.
Okay, so the financial position is going to have what? Disclosure, layout, format. Okay, it's a nice way to present information. So you'll have financial position, you'll have financial performance, you'll have cash flows, and you'll have equity. Those are the four main statements that you'll see when looking at statements. Okay, the statements that you're going to have to focus on: the financial position, the statement of comprehensive income, and the statement of changes in equity. Okay, those are the ones that they can test you on. Okay, so we've covered journals before. You know that journals are broken up into cash and credits. Cash journals will affect which accounts? Bank will either go up or down, depending on what's happening. Purchases. Who do we buy from?
From creditors.
Exactly. Okay, so we buy from our creditors and we sell to our debtors. So our purchases journals, be it the purchases journal or the returns journal, will always affect the creditors, okay, our liability. And then our sales and sales returns will affect the debtors. Okay, this we've covered before. It's just a recap slide. Okay, instead of you writing it in, I've given the answers. And then the last one is general journal. General journal has all the other transactions. Okay, so the ones that we've looked at are adjustments. So you need to remember your Chapter 7 adjustments. Prepaid expenses, accrued expenses, depreciation, all of that. Journals are just boxes for grouping transactions. That's all it is. Okay, journals are useful because I can record all the transactions, and we might have like 1 million transactions, and then all of that gets summarized and goes to the... Where do we put the journals?
No, general journal.
No, in the ledger.
Oh.
Okay, so the journals go to the ledger.
Okay.
Right, how is the ledger different to the journal? The journals group transactions. What does the ledger do? The ledger analyzes specific accounts. So in the ledger, you'll have like a bank account. In the ledger, you'll have an account for debtors. In the ledger, you'll have an account for creditors. So a ledger is looking at specific accounts. Transactions are looking, well, not transactions, journals are grouped in, or let's put it this way, journals are used to group the different transactions. That's the difference. Okay, so the one is more for the transactions and the other is more for the actual accounts. Okay, is that right? Okay, so that's what you've got here in terms of the journals. After the journals, we need to look at this, disclosure and layout. So when looking at forms of ownership, you know we're going to be focusing on the first one. The others you don't do in this module. Okay, so it's not important for 1502. Right, with 1502, you're going to be focusing on a single individual owning a business, and all the disclosure will be in line with that. Okay, capital would be capital, drawings will be drawings. You don't have other accounts for capital and drawings. This one you are going to look at, that's the next study unit 16. 16 is looking at the non-profits. Okay, where you'll have something like a sports club. So they like talking about tennis and cricket and different sports. Okay, so you'll have a club where you'll actually go and play sports. Right, so do you participate in any sports?
Yes, squash.
Okay, so when do you go?
During the week, on weekends.
Okay, and where are you going?
To Krugersdorp.
Okay, so that would be a sports club. You're probably paying a membership fee to belong to the club.
No, we're not playing that often.
Okay, but if you were a member of the club, you would have to pay
A
membership fee in order to belong to that club. All right, and that fee goes towards running the actual sports facility. Okay, so keeping the lights on, making sure that the floors are nicely done and all of that. Okay, and then once you've got the they call it committee members. Okay, the committee members are the ones that actually make decisions for the non-profits. Okay, but do the committee members get any benefits? No, they just help manage the club, right? But the club's focus is on the sport or the science or art or whatever the club was formed for. Okay, so you get different clubs with different things. Okay. When applying the rules, we need to apply them to disclosure in terms of where do I put the correct accounts? Do I put it in the statement of financial position? Do I put it in the statement of comprehensive income? Okay, so it's all about where do I disclose the information. These are things that we've looked at before, objectives and characteristics of financial statements. Okay, this is looking at background information. What are we going to consider when looking at the financial statements? Well, the first thing is, must they continue or must we show statements that show that the business will continue forever? Well, yes, if the business will continue. So going concern is looking at that. Is the business going to continue to operate? If the business isn't going to continue operating, can I show it as a going concern? No, I can't. I need to show it as a company that will go bankrupt, okay, or stop operating. Right, relevance is? If something is relevant, what does that mean?
It needs to be in
Correct.
line with.
Yeah, it needs to be part of the actual statement. Okay, so if something isn't relevant, then you wouldn't record it. It's not considered as part of the actual disclosure. Okay, so only things that are relevant. And how do we know if something's relevant? It's material. Okay, this is just background information that came from chapter 1. Okay, faithful representation. Are things true or accurate? Comparability. Can we compare? In other words, can we look at year by year by year? Or can we compare different accounts? Verifiability. Do we have an audit trail? Okay, so can we account for those payments? Do we have the invoices? Do we have the receipts? Do we have all the documentation that allows us to verify what actually happened? Okay, timely things need to be recorded correctly and on time, correct. Understandability is the disclosure. Okay, so do I know what assets are and what type of assets do I have? Non-current is different from current. So you would have to show the difference between your assets and your liabilities in terms of timing, long-term and short-term. Then you've got income and expenses. Same thing applies there. We're looking at profit though. Okay, we need to disclose it. And then the last two is the capital and the drawings. And we use that for the changes in equity. Okay, so that's what we've got in terms of the disclosure. Right, so this is an important slide because I've given you definitions and I've summarized the actual disclosure as well. Okay, so assets and liabilities help us to calculate what? The answer's here. Financial position. Okay, so we've covered this before. We know financial position is where are you now. Right, so what are your assets? What are your liabilities? Okay, if my assets are more than my liabilities, good or bad position?
Good.
Good position, correct. Okay, so if I've got income and expenses, what am I calculating there?
Comprehensive income.
Profits. Okay, so make a note. Profit equals what? Income minus?
Expense.
Correct, and that's a statement of comprehensive income. Okay, which two definitions don't you see here?
Creditors and debtors.
No, creditors would be a liability, debtors would be an asset.
Oh, capital and drawings.
Good. Okay, so capital and drawings belongs to who?
Owner's equity.
Correct, the owner. Perfect. Right, so which statement do you think that'll go to?
Owner's equity.
Statement of changes in equity. Yeah, but owner's equity is correct, so that's what you're looking at. Okay, so capital, statement of changes in equity. Drawing, statement of changes in equity. The one the owner takes, the one the owner gives. Okay, what is owner's equity? You have two equations for it. That's the one equation. That's the one looking at equity, where you've got the capital and the drawings. What's the other equation? Do you remember? Think accounting equation. What is the accounting equation? OE equals? A minus L. Correct. Okay, so do you agree I can use either two? And that's important for the last chapter, the incomplete records. Okay, if records are incomplete, what does that mean? We're missing.
Not complete.
Yeah, we're missing information. So if I'm missing information, what do I need? I need an equation, because the equation must balance. What's on the left, what's on the right must
Be equal.
be equal, exactly. So I can find missing figures if I don't have all the information, as long as I've got an equation. Okay. Next bits. Rules. Why do we need them?
To do the accounting correct.
Okay, so the analysis and the interpretation, that's one reason. The other reason would be disclosure. Okay, so asset will have debit balances, we would disclose that on the debit side. Liabilities would have credit balances, we would disclose it on the credit side. Okay, so obviously debits and credits have to equal, and by using these rules, we can then interpret transactions correctly in order to create the statements. Okay. Basics. Do you remember a general ledger? Okay, so in the general ledger we'll have different accounts, specific accounts. Right, so each of these accounts will have a debit side and a credit side. Do you agree? So what account do I have there?
Bank.
Good. What is bank?
Asset.
Correct. Okay, so bank is an asset. This is one general ledger account. What other accounts can we have?
Liability.
Okay, you can't have a liability account. You'll have an account that is liability.
Okay.
So what other accounts can you get?
A lot.
Give me some other examples.
Furniture.
Okay, what would that be?
Asset.
Correct. Okay, so furniture is another account, but it's still a
Asset.
asset, exactly. So you get different types of elements, but they're all specific. Okay, so can I record furniture as equipment? No, they're different things. Okay, so you should identify those things differently. Okay, that's the purpose of a general ledger. General ledger is going to be specific accounts. Okay, so one account for every little thing. Okay, account for this, account for that, account for this, account for that. Okay. Balances, you obviously start with a balance. Here there was no balance. Then you had receipts and payments. Receipts do what to the bank?
Increase.
Correct. So that's why it's on the debit side. That's why rules are also important, because it can also help with disclosure in terms of showing your general ledger and then transferring the information through to your financial statements. Okay. Total payments decrease our bank. Okay, when I make a payment, bank is coming down. Right, then what do? I add up those two sides and I see which side's bigger. Which side's bigger in this example? The debit side, yes. Okay, the 36878 is bigger, and that's why I carry down a balance and bring down a balance on the debit side. Okay, so you should be okay with that balancing.
Yep.
Right, there's a note about balances, trial balances. What are they used for?
Summary of general ledger accounts.
And it's used to check. It's a checking process. Okay, so what is the purpose of a trial balance? Or what do we use the trial balance for? Go back to that diagram, the first one we had. What's the step just before the financial statements?
Trial balance.
Good. So what is the trial balance going to help us do?
Adjust.
No, not adjust. The trial balance is going to help us create the statements, because I'll have a list of all the accounts. Where do the accounts where do the balances in the trial balance come from? The general ledger. Okay, so remember we said general ledger keeps all the specific accounts. I'll have one account for bank, I'll have another account for equipment, I'll have another account for furniture. I'll have all these different accounts. Okay, and then what do I do with all these accounts? I group them in a trial balance. And the trial balance is going to check that you've captured them correctly and that debits are equal the credits. That's what you're actually looking at. Okay, so you're just grouping the accounts. and you're checking if the balances balance. That's basically what you're doing. Okay. Right, so let's test your knowledge. Do you remember what each of these adjustments are? Explain them to me. So let's talk about a prepaid expense. Tell me everything you know about a prepaid expense.
It's paying in advance.
So,
Say for instance, your cell phone contract is for 12 months and you pay 13 months.
okay, so what does that do to our accounting records?
It's an asset
Why?
because they owe us the service.
Exactly. So, how are you going to capture that in your books? Debit or credit?
Debit.
Good. Okay, so the first one is an asset and it's a debit. There you go, you've got that. Okay, so it's important to understand the adjustments because you are going to have to provide for them. In chapter 15, that's exactly what they ask you to do. Okay, what is an accrued expense?
It's a liability.
Why?
It's an expense that we didn't pay for, say, 3 months.
Correct. Okay, so accrued expenses are expenses that are billed after you've used it, like water and electricity. Okay, it's anything that's outstanding. So liabilities have which balances?
Credit.
Credit balances. Okay. Right, then you've got consumable inventory adjustments. So what would an example be of something that can be consumed that'll be seen as an expense?
Stationery.
Yes. Okay, so stationery is well, I wouldn't say it's an asset. Stationery is an expense, but it can be an asset when? At year end. Okay, because remember, we're looking at 12 months. Yeah. Right, so if you buy a lot of stationery during the year and you don't use all of it, the stuff that you haven't used is going to be classified as what?
An asset.
Correct. Why?
Because you still have it in stock and
yes.
you can use it for the following year.
Correct. It's a resource that you're controlling that's going to give rise to future economic benefit. Because I won't use the stationery this year. I'm going to use the stationery next year. Okay, so in the current year, I'm going to record it as an asset. Does it make sense?
Yes.
Okay, so consumable inventory adjustments is an asset. It gives rise to an asset. Okay, we've looked at all of this before. Let's just recap and revision. Income received in advance, what is it? Describe it. Tell me what you can.
It's a liability because we owe them a
Correct.
service or product.
Correct. So income received in advance is a liability to the business because it's not earned yet. Yes. Okay, so debit or credit?
Debit.
A liability.
Oh, it's a credit, sorry.
A liability will have a credit.
Credit balance.
Yes, credit balance. Accrued income?
It's an asset.
Accrued income is an asset.
Because it's income for, say, 3 months that we haven't received, so they owe us.
Exactly. Okay, so an amount that's outstanding that has been earned.
Yes, and it's a debit.
It would be a debit. Right, last two, what are these?
Credit losses and bad debts, people not paying us.
Credit losses and bad debt, people not paying you. Correct, that's what it is. So how would you capture it in your books?
A liability.
It wouldn't be a liability. Think about it. Which definition does it meet? We just saw the definitions before. Which one?
It's an expense.
Correct. Why?
Because they're not paying us, but they took the service or the...
Correct. Okay, so what happened? You wrote off some stock in your company because you couldn't find it. Okay, so if you wrote off some stock on behalf of the company, that's seen as a loss, a credit loss. Okay, but a credit loss would be for a debtor. Okay, so we would write off a credit loss if someone didn't pay.
Yes.
Depreciation?
Waardevermindering.
Which is?
It's like, for instance, a vehicle's worth is going off every year.
So, what impact does that have on your books? what would it be viewed as?
Owner's equity.
No, depreciation wouldn't be owner's equity.
Expense.
Yes, why?
Because you need to. The worth of the asset is going down.
Correct. So if the asset is reducing in terms of value, what does that mean? Are we losing something or are we gaining something? You're losing something. Okay, so expense. Alright, so that's actually really good. You remembered all the adjustments. See, right, it's just a matter of revision and practicing, okay, in this particular chapter because it's disclosure. Right, and that's important because accounting rules need to apply when disclosing information. Okay, so now we need to look at some examples.